Yeah, it looks perfect.
Great. Okay, so no crashes this time around. So yeah, let me start by thanking Dimitri, Neil, and Christian for putting our paper on this program. I'm really happy to be given the chance to present this today. My name is Heiner Beckmeyer. I'm a PhD student from the University of Münster in Germany, and this paper is on option return predictability with machine learning and big data, and is a paper that I've co-authored with Turan Bali and Mathis Moerke, who are both also in the audience tonight, and Florian. So as the title suggests, we're dealing with whether we can use modern machine learning methods to predict future option returns. And the main motivation where this is pretty topical and an important avenue for research is to have a look at this graph, which we have taken from Goldman Sachs, and which shows the relative amount of trading in the option market on single equity options versus the underlying stocks. And what you can clearly see here is that from the beginning in 2006 up until mid to 2020, we can see that this relative trading volume is definitely on an upward trajectory. So that means that relative to share trading, options have become increasingly important for investors. And it's very interesting to note this spike right here. So during the onset or during the coronavirus sell-off, we see that the option volume actually exceeded the option transacted in the underlying stocks, right? So this kind of warrants a closer look at what happens in option returns and whether we can find ways to actually make informative statements about future option returns. And so far, especially compared to other asset classes, there's comparatively little known about the factor structure that we have in individual option returns. And of course, options themselves are highly nonlinear instruments. So we use machine learning techniques, which explicitly allow us to understand how nonlinearities of input characteristics and interactions between characteristics, both of the stock and the option contract, influence future option returns. And in this paper, we focus on predicting returns rather than identifying the best fit factor model. So, we take a very reduced form stance on this issue. Importantly, we deviate a bit from the previous literature in that we don't only focus on short-term at-the-money options, but we actually look at the whole range of options trading on single equities in the US. So, you might think that a out-of-the-money put behaves quite differently from in-the-money put, right? Or even from an at-the-money call. So we want to be able to assess how these differences come about. With this, we try to answer 4 questions. The first one being whether nonlinearities, so allowing for or using models that allow for modeling nonlinearities improves the prediction performance, whether this predictability that we find is economically significant, which characteristics are driving these future option returns. So we actually want to look into these machine learning models, which have often been dubbed as black box models. And lastly, whether we can find a compelling economic story for the option return predictability that we find. In a nutshell, what we find is, kind of unsurprisingly, but also quite interesting, is that allowing for nonlinearities actually increases the out-of-sample performance using option and stock characteristics to predict future option returns by quite a lot. Second, we can find that nonlinear machine learning models generate highly profitable trading strategies, long-short portfolios, even after we account for moderate to high levels of transaction costs. We find that on a standalone basis, characteristics that relate to the option itself are most important, but also including information about the underlying stock actually offers substantial incremental predictive power. And lastly, we can connect the return predictability in options that we find to informational frictions, costly arbitrage, and option mispricing. So I will start with the methodology, which I will keep kind of brief. Suppose we have an option I that trades on a given underlying S, and we want to know about its return from time t, which is today to t+1. we simply assume that the return is the sum of the expected return and then some type of, expectation error, pretty much. And we assume that we can approximate this expectation here through a function g, which is a simple mapping, or which simply maps p observable characteristics at time t to expected returns, right? And we then assess whether we have found predictive power in future option returns by the out of sample r squared right here, which essentially just compares the predictions we make in our machine learning models to a benchmark which always predicts a zero return, right? We also consider cross-sectional R squared, which deducts the cross-sectional mean that we see, and which is more in line with the standard, asset pricing idea of looking at return spreads. The option returns, so that we use, so the thing that we want to, predict in the future, is just the delta hedged option return. So assume that V denotes the price of our option contract I. Then we assume that we buy the option at time t, hold it until t+1, so for 1 month. And then for each day during that month, we rebalance a stock position against it such that our delta is always 0. So we really want to make sure that we do not conflate our option returns here with anything that comes in from the underlying, because numerous studies have shown that stock returns themselves are predictable, but we want to focus on the higher order terms here, right? So are these higher order terms also predictable? We then scale this, as is customary, by the absolute investment value here. Now, the models that we use are pretty much standard, and we follow the Gu, Kelly, and Zhu paper here, which is kind of set of a huge literature and using machine learning methods in finance. We have 5 linear models: ridge, lasso, elastic net, partially squares, and principal component regression. And we also use 4 nonlinear models. 3 of these are tree-based models, so random forest, a gradient-boosted regression tree, as well as a gradient-boosted regression tree with dropout, which has been shown in the computer science literature to outperform the regular gradient-boosted tree by quite a lot. And we also have a look at a feed-forward neural network. Then, to kind of compare whether linear models are outperformed by nonlinear models, we also form equally weighted ensembles of all linear and all nonlinear models, because the literature has shown that using these ensemble methods actually provides or potentially provides large benefits in prediction tasks. To estimate our model, we kind of follow the standard train, validate, test sample split. So for the first year that we want to predict, which is 2003, we use 5 years to train the model, 2 years to validate the hyperparameters. So how does the model structure itself look? And then predict returns for 1 year. Then we roll everything forward 1 year, but keep the start of the training sample fixed, so that we now train on the first 6 years, then the first 7, and so forth. So to the data, we have big data in the title, and we actually use a quite large data set. We use 25 years of data from 1996 through 2020. And we obtain roughly 12 million contract months observations after filters. And we use rigorous filters here to really make sure that the quotes that we use are pretty valid. For example, we exclude very short-term options. We make sure that in the implied volatility surface, option prices are convex and all that type of stuff. These 12 million contract months observations are on more than 7,000 unique underlines. And we also categorize, we basically partition the implied volatility surface into option buckets, which relate to the time to maturity and the moneyness dimension, to be able to compare how well our machine learning models can predict future returns within these buckets, right? We map CRISP and ContiStat data against that for stock-based characteristics. All the option stuff is from option metrics, and that's it. Now, we have 193 stock-based characteristics, 94 that we used in Green et al. And Gu, Kelly, and Zhu. 90 industry code dummies, as well as 9 other stock level predictors that we add, which have been shown to be to have predictive power for other asset classes or also options. And we also add 77 option-based characteristics, right? 42 of these operate on the stock level. For example, the IV-RV spread, the spread between the implied and the realized volatility, or the option implied shorting fee. 19 operate on the option bucket level. For example, illiquidity measures or volume measures, right? Because we need a time series for these. So we basically assume that within a bucket of a given underlying, these characteristics are kind of fixed over time so that we can actually measure these illiquidity measures. And then we also have 16 option contract level characteristics, for example, the implied volatility, the time to maturity, or the moneyness. So in total, we use 270 characteristics, which we can also classify into groups, and I will talk a bit more about that later on. So the first part of the paper is a standard model comparison. Is it worthwhile to invest in the computational expenses of using nonlinear models? And the resounding answer to this is yes, because nonlinear models are actually pretty much necessary to uncover predictability in option returns. We find huge benefits of forming ensembles. And the reason, in the literature for this is that this guards against covariate shifts. Different models tend to focus on different connections between characteristics and returns. And the likelihood that some of these connections are valid for different subsamples is higher if we use more models. And we also find that tree-based methods and the nonlinear ensemble outperform all other methods. Now, this is not really a surprise, given the tree-based methods have been shown to be far superior to, for example, neural networks on structured data sets. And finance is pretty structured, most data sets. So this is what we get. On the left here, you see the out of sample R squared. So how much variation, future variation, can we explain with our predictions for the 5 linear models? And you can see that most of this is negative or around 0. If we look at the nonlinear models right here, we can see that some of these manage to predict future returns quite well, right? For the overall, so using all options in our sample, we can obtain a future or an out of sample R squared of about 2.7%. Focusing on puts, this is above 3% for the DART model. Now, if we form ensembles of the linear and the nonlinear models, we can show that, for the linear model, the increase is quite clear. For the nonlinear model here, it's not quite as clear. But if we compare the cross-sectional out of sample R squareds here, we can actually show that using these ensembles is worthwhile. We also find that for all tree-based and the nonlinear ensemble, these predictions, these out of sample R squareds, are actually highly statistically significant. Now, what has been overlooked so far, or hasn't really been looked at too much in the literature, is how dispersed are our predictions? So how well do we predict future option returns over time for each year in our sample, right? Because I, as an investor, I want to know if I invest following a model that tomorrow I'm not going to be completely out of luck and pretty much do random predictions. So what we look at is how dispersed is the out of sample R squared for each year in our sample. And what we find is that linear models tend to fail quite miserably here, right? We see a large dispersion of the out of sample R squared. If we take the ensemble, it looks much better, but it's still outperformed quite handily by all of the nonlinear models. Now, if we form an ensemble of the nonlinear models, we find, here are the benefits of using this ensemble, because we find that the predictability actually never dips below 0 in any of the years in our sample. If we look at the cross-sectional R squared, this looks even more drastic, right? So we find that we not only have higher predictability, but also a lower dispersion of the predictability over time. Now, we also want to make a statistical statement about whether one model outperforms another. And for that, we rely on Debord-Mariano tests. And we use new US standard errors with 12 monthly lags to account for serial correlation in the predictions. And what we find is this. Now, to read this table, whenever, for example, here for LEN and ridge, if this number is positive in blue, this suggests that LEN, the linear ensemble, statistically outperforms the predictions of ridge regressions, right? For example, we find that LEN statistically outperforms most linear models, right? And if we then compare the nonlinear ensemble to all the linear models, we find that it outperforms all of these. Also, the linear ensemble right here, right? Within the class of nonlinear models, we find that all are pretty good. And the reason why the nonlinear ensemble does not outperform the feed-forward neural network, despite, if you remember, the R-squared is much higher, is because the feed-forward neural network does a good job actually explaining these return spreads, so the cross-sectional variation here. Yeah, and we now have a look at this, again, over time, a direct comparison of the linear and nonlinear ensemble. Do we really need to model nonlinearities? And the answer to this is yes, right? Both ensembles tend to beat the naive benchmark, but the predictions by the nonlinear ensemble are much more consistent. And the predictive power has stayed roughly constant over time. In fact, if we compare the out-of-sample predictive power of the linear and nonlinear ensemble, we find that almost 80% of the months we are in this green region here, which suggests that the nonlinear ensemble outperforms the linear ensemble. In red, we have indicated the coronavirus sell-off period. And even during this time, we find that the nonlinear ensemble outperforms the linear one. And B, we actually find pretty high predictive power here. So the connections that the models find held throughout the coronavirus sell-off, which is actually remarkable given that the testing and the training data for these models for predicting returns in 2020 stops in December 2017, right? So this speaks in favor of our estimation procedure here. As I've said, we can also have a look at this for different moneyness and maturity buckets. If we do this, we find that the nonlinear ensemble always outperforms linear models. So nonlinearities are key. Now, we can create portfolios off of this, so trading strategies. So each month, we sort individual options into 10 decile portfolios based on the predictions by the ensemble methods. We'll calculate value-weighted 1 month ahead average realized returns of individual equity options, and then compute the average long-short portfolios. And this is what we get. So down here, looking at the linear ensemble, the high minus low portfolio is predicted to earn 2% per month. In actuality, this is 1.2% at a Sharpe ratio of 1, all measured monthly. For the nonlinear ensemble, we predict a return spread of 2.4%. We managed to get 2 at a Sharpe ratio of 1.4. And the difference between these two models, right, the high minus low portfolios, is highly statistically significant in favor of the nonlinear ensemble. These results are robust to using equal weights. Robust during different market phases. We can account for the exposure of common risk factors, and it also holds across all of the option buckets that we consider. Now we can also have a look at trading costs, right? And we all know that in the options market, trading costs are pretty high. Now, if we expect the investor to, on average, pay an effective spread of 25% of the quoted spread, right, of the end of day quoted spread, we can see that for the full sample, we still obtain a profitable trading strategy. If we increase the spreads further to 50%, all of a sudden, this all goes away. But if we focus on short-term options, even considering effective spreads of 50%, we can still generate highly profitable trading strategies for all but in the money calls, right? And as a next step, we kind of want to look more into, the machine learning models. What can we actually learn by, from the predictions? What can we learn about option returns? And we first have a look at the relative importance of various characteristics groups. We have 6 that relate only to stock-based characteristics containing information about accruals, industry, investment, profitability, quality, and value. We have 1 that is exclusively filled with option-based characteristics, everything relating to the contract. And then we have a mixed source characteristics group. 1 is about frictions, 1 is about illiquidity, informed trading, past prices, and risk. And here we use a state-of-the-art machine learning method called SHAPS, Shapley Additive Explanations, which approximates the effect of excluding a feature and then refitting the model, because doing this for 270 characteristics would be quite tedious. If we do this, this is what we find. So the most important feature group here, the most important information is knowing about where the option lies on the implied volatility surface and where the implied volatility surface lies relative to the other implied volatility surfaces, so of other underlyings. A runner-up is illiquidity, risk, and past prices, right? And these are mostly information which we take from option contracts. If we have a look at the 10 most important characteristics for the nonlinear ensemble, the most important one is the IV. So we have to know what is the price, where does it lie on the IV surface, but also the bid-ask spread of the underlying, for example, right? So there we can kind of see that information about the underlying is also very important when making informative statements about future option returns. We also find that the realized volatility, the IV-RV spread are also important, so there seem to be some relation to risk-based variables as well. Now, I've said that we don't want to refit the model 270 times, but we actually did it a few times, right? Because the Shed values actually kind of fall apart if you assume or if you exclude a large chunk of the information at once, right? So here we simply refit the model using only a subsample of the information set, right? To kind of give an overlook on this, we find that option-based information is most important, but also that contract-based information, despite being the most important group, alone is insufficient, right? So there are important interaction effects between characteristics of the contract and the underlying that we have to take into account. And one statement of the paper is basically to include as much information as possible. And if we look at this, right here, this is what you already know. This is the out of sample predictive power for the full model, having access to all information. Right here, we restrict the information set to only option implied information. And you can see that the benefit of including also stock-based characteristics is about 1% out of sample R squared, right? So it's pretty large. Then if we go one step further and only include bucket and contract information, right? So we exclude all the information that relates only to the underlying stock, we again lose, about 0.8% predictive power. So overall, the inclusion of stock-based characteristics is super important, despite the fact that we observe close to no predictability if we only use stock-based information for predicting future option returns. We also perform Dewalt-Mariano's subsample tests here. And what you can basically find is that for both the linear and the nonlinear ensemble, it's always worthwhile to include as much information as possible. So the full model always outperforms the models where we assume that the investor pays their attention only to a subset of the information. And we also find that the nonlinear ensemble actually beats all of the linear ensembles here. So in the last, I don't know, like 5 minutes probably, I want to talk a bit about sources of predictability. And because of the time constraint, I will focus on one source right here, but we actually discuss 4 in the paper. So, we investigate whether there is an economically motivated mechanism and story behind this option return predictability that we find. And we consider the presence of informed traders. We consider whether demand pressure by different option market participants has an effect on this predictability. We also consider costly arbitrage, to whether it plays a role. And then lastly, we have a look at more generically whether option mispricing can explain our predictability, at least in part. As I said, in this talk, I will focus on the presence of informed traders. So our hypothesis is that the option return predictability that we find, at least in part, originates from informational frictions, right? If we assume that they're informed or sophisticated traders in the market and that these have a higher ability to process information, they will trade on mispricing, for example, sooner, right? And in the presence of many informed traders, information should therefore diffuse faster into prices, and we would observe less predictability. We use 2 proxies for this presence of informed investors. One is institutional ownership, which are deemed to be more sophisticated and exhibit superior information processing abilities. And the other is the amount of analyst coverage. So how many analysts are covering the underlying stock, which has been shown to be an important channel through which information is incorporated into asset pricing. If we do this, and first we will focus on the predictability, this is what we end up with. So we sort each option into quintiles based on the share of institutional ownership and the analyst coverage at the stock level, and then have a look at whether we see changes in the predictability. And indeed, this is what we find, right? So for very low levels of institutional ownerships, we find the highest level of option return predictability, which then drops quite heavily, but is still statistically significant. In contrast, for the analyst coverage, right, we see a monotonically decreasing predictive power of our best performing machine learning model in the options, such that for low analyst coverage, we see predictability above 4%, which is highly statistically significant. If we move up to the highest quintile of analyst coverage, this predictability pretty much vanishes, or is at least statistically not significantly different from zero. And the same basically holds if we look at this cross-sectional R squared, so cross-sectional return predictability. Now we also set out to have a look at trading strategies based on this. So within each of these institutional holding and analyst coverage quintiles, we again have a look at low predictor or options which are expected to perform poorly and options that are expected to perform well. And we again have a look at the return spreads here. What we find is that, considering these high minus low spreads here, we find that regardless of the quintile of institutional holdings and analyst coverage, the return spreads are large and statistically significant, but we find that in both cases, they're actually decreasing, right, in the institutional holdings and the analyst coverage, right? So at least in part, and for the analyst coverage, this is actually monotonically decreasing, which is quite remarkable. So, at least in part, we can show that the predictability and the profitability of the resulting predictions is connected to the presence of informed traders. This is pretty much it. I will conclude. And what we've done in this paper is use a large cross-section of option and stock-based characteristics for 25 years on a huge amount of option contracts, and we try to predict future returns. We find that the complexity of the machine learning models matters for prediction, and that it is very important to be able to model interaction effects between characteristics, because that's where tree-based models pretty much excel, right? We can form a trading strategy based on these forecasts, and this is highly profitable. And the most important characteristics are those that describe the options location on the underlying's implied volatility surface, but alone these characteristics are insufficient. So you need also information about the underlying stocks. And we find evidence that this return predictability is related to stories of informational frictions, the existence of costly arbitrage, and mispricing, general mispricing. And I hope I'm on time. I haven't tracked it, so let's hope.
You're just on time, so thank you very much.
That's great.
Not much time left for questions, but anyway, there'll be time for a few. There were several comments in the chat that I didn't interrupt you with because they didn't need to be addressed right away. And again, Dimitri will send you the chat sometime later today, or maybe for you early tomorrow. But there was one question from Dimitri. Does this ML option return model also predict stock returns?
It's hard to check that, right? Because the input space would be a lot different, right? If we now included stock returns, and I don't think that is really the focus of what we want to get at. But I agree that would be interesting to look at. It would also be interesting to see whether stocks that are predictable have predictable options, for example, something like that. But right here, we really want to focus on, the option part and whether we find differences in the predictive power and also, differences in the sensitivity to input characteristics, given a different, an option of different moneyness or time to maturity and the like. Yeah.
Actually, there is a paper looking at that, Dimitri. There is a paper looking at whether machine learning models have predict future stock returns using stock and option characteristics, but they use very small number of option characteristics. They don't have big data set as we use.
Yep.
Okay, other questions? Feel free to unmute yourself and shout your question out with your microphone.
Steve Figluski here. I find both of these papers just really interesting, and obviously there's an awful lot in the papers that cannot be given in a 30-minute presentation. But I wonder about the machine learning kind of an approach. Is this something that one can use for hedging option positions? If you're a trader, for example, if you're a market maker, does this help you? Do you get deltas out of a model like this?
Well, out of this model, no, we don't. No, we don't get deltas out of this model, right? Because we follow this very reduced form approach where we basically just say, okay, there's some mapping of characteristics to future returns. But, in a way, there are definitely ways to set up machine learning models that would approximate the delta and other derivatives of options, possibly much better than, say, Black-Scholes approximations. So it's possible to do, but not in this setting here.
Well, that would probably be a direction worth exploring. So what you're saying, I think, is that this kind of model is useful to us for understanding what determines option returns, but not necessarily useful for risk managing option risk. Was that a fair characterization?
Well, yeah, in a way, yeah, because we are more interested in, trying to find determinants of future option returns rather than saying, okay, we are, say, a market maker and we want to better manage our book. Yeah. Good.
Steve, that's a very good question. In our current version, we don't investigate what you're asking, but it is doable. It is doable. It's a very good question. That could be, but we need to work on it. But yeah, thank you, Steve. Thank you.
Other questions?
All right, I'm going to ask another one if no one else got anything to say. Bid-ask spreads in the options are really huge. I was pleased to see that you took that into account. And yet, if you're going to make a trading strategy, well, I guess my question is does your trading strategy take account really of the fact that you've got to be trading in a market that is quite illiquid for those options?
Well, not really, right? We basically assume that the quoted spread that we observe in option metrics is a reasonable proxy. And, as I said, we can go up to 50 and for some options, for these short-term at-the-money options, to 75% of these quoted spreads and still get profitable trading strategies out of that. But yeah, it's an approximation, right? And we leave, margin requirements out of the equation or continuously delta hedging the underlying. So we really want to focus on this option part here. But I agree, yeah, that would be interesting to look at. But I guess, again, you would probably set up a different model for that, right? Which more so takes into account the impact of its own trading in a way, which it doesn't really do at this stage.
Well, I would think part of the point really is that we automatically assume that the midpoint of the bid-ask spread is the actual value of the option, and we proceed to estimate models based on that assumption. But there's a huge range in there,
yeah,
and that's a big assumption, I think.
Yeah, definitely.
Well, what you are doing is really interesting. I mean, showing the importance of taking account of the stock characteristics in addition to the option characteristics. That's a very nice result.
Yeah, I was really happy to see this result, right? It's empirical work, so you never know what you're gonna get, but I was happy to see that. Yeah. And to Dimitri's question about the S&P 500 stocks, I think we've done something like that at some point, basically looking at quintiles of the underlying, the size quintiles of the underlying. And as I think the predictability goes down, definitely, but it's still there, I'm pretty sure. And what we also did just now is refitted all of these models only using the short-term at the money options, which have been the focus of the recent literature on option returns. And we actually find comparable levels to the full model, right? So maybe that adds to that question a bit.
So just one observation. Well, actually, there's a small question. Are games on the chat? Are GameStop options cheap or expensive? Probably GameStop is not one of the stocks underlyings you consider.
Well, I think the GameStop frenzy started in 2021, right? So we don't
Yeah,
actually
okay.
have the data on that.
It's
But
not
it would
in-
be
it's not in your
interesting to
sample.
check. Yeah. And yeah,
So-
I'm not sure whether we would actually include these options after the filters. Yeah.
So Neil, I have a question.
Go ahead,
I don't
go
know if yes, Turan. Yeah, I like this paper. So
Thanks for
so
saying.
my only question is, so here you use non-linearities like in options to predict. So and you use the out of sample R squared, like, which is based, if you look at the out of sample R squared, it is based on a measure closely related to variance, closely related to like variability, dispersion, right?
Yes.
So then for me, it's not something specific, a question to your paper, right? It's something to the profession in general, right? So for me, it seems that every time we go beyond like variance, like we try to look at nonlinearities and exploit that to predict, to have better prediction results, then we need to come up with, an additional measure, okay, out of sample measure that actually takes into account these nonlinearities, because I'm a little bit afraid that the variance by itself, which is not specific to your paper, like the variance by itself or the outer sample, the way it is defined now, it is often used, is not enough.
Sure.
You see what I'm saying? Because if we try to use nonlinearities, we get better result. But again, given using the outer sample that we always use now, but for me, we need to maybe, not you, but we need to think beyond that and see if it is possible to come up with a new measure or a measure that improves on that to say something about, predictability out of sample, like out of sample predictability.
Well, yeah, I definitely agree. The thing is, right now we are modeling nonlinearities in the characteristic space, right? So this is not a statement about what happens to the predicted returns, right? They can still be perfectly normally distributed. And then, it wouldn't really be an issue, I think. But I haven't checked this, so it's a good comment. But again, the nonlinearities here are inside, so higher order terms of characteristics, if you look at neural nets, or interaction effects between characteristics, right? So it's not a statement about the expected returns that we get out of the model, right? They can be, again, perfectly normally distributed if the model decides that that's the way to go. So I guess in that case, you could still, at least to my understanding, use this out of sample R squared without issue, right? But I get what you're saying, and I agree.
They are good, right? They are good.
Yeah.
Like, I'm not saying that I have a problem with that. Okay, everybody uses that. I use this too, right?
Yeah.
I use it too. What I'm saying, like, maybe, there might be, I don't know. Maybe if you are aware of that, let me know. So I'm just thinking about maybe something could be out there that, that would be like, an improvement. Yeah, I don't know. Neil, what do you, I don't know.
I don't have a great suggestion right now, but anyway, I guess maybe there's time for one more question.
Yeah, I just want to make a comment. Like when When you said, okay, that there's this nonlinear relation between contract characteristics and returns, I'm kind of like, well, given that you use the entire all the options for an individual stock, I'm kind of not surprised, because I mean, we know that moneyness and maturity have a nonlinear relation with implied volatility. So then I'm sure that that's going to translate into option return somehow. So
I agree, and we have received this comment before. So what we did was we investigated, I think I showed this one graph where the nonlinear model always outperforms the linear model regardless of the option bucket. That's one part of it. The other is that we have re-estimated the model only using the short-term at the money options. So, where you could say that, interaction effects across the moneyness and time to maturity spectrum are less of an issue. And we come up with comparable levels of predictability. So that doesn't really seem to be, an issue here. And we've also looked at, these partial dependence plots using these Sharpe values, trying to understand, do we say for implied volatility, if we then condition on quintiles of the moneyness spectrum, do we see that the expected returns differ? And for example, I still have this in my head, the IV part, we don't see much differences across the moneyness spectrum here, right? So the nonlinearities are always there in the IV. So there's a nonlinear relationship between IV and expected returns, but this does not seemingly depend on, say, moneyness or time to maturity. There are other variables where this is a factor, yes, but it doesn't seem to be the general case. So the nonlinearities that we could pick up are not per construction in a way, right? And I agree, and we really, in this new version that is coming up, we really want to address this part because we see that it is, very important to address. Yeah.
fair enough.
So I'll step in. Thank you, Aurelio. Thank you, Heiner. I'll just